Good morning and welcome to the Saxo Bank Morning Call. It is Wednesday, December 19th, and it's FOMC day. And Ola, I don't think I can recall an FOMC meeting where I was less sure of what I think is going to happen here. Yep. And also simply have no idea what the market's reaction function is going to be to this. There's a lot of drama going into today's meeting. We'll talk about that shortly, of course, but just a little bit of a recap of what's been going on in markets. Got a chart here of the U.S. 10-year. It's, I think no coincidence, the yield there on that benchmark descending to this 2.8% level. It's around the massive support line going way back really to the beginning of this year. As there's been a tremendous safe haven bid into U.S. Treasuries, there was a Bloomberg article talking about, I think it was Bank of America, this huge rotation into bond markets and away from stocks, something like the largest shift for a week that's was seen since the 2008 timeframe. And then if we look at equity markets, we saw the S&P 500 closing near the lows, not quite posting new lows for the cycle on the daily close, or if it was a point or two. But interestingly, the U.S. Russell 2000 really been getting the worst of it lately. Dramatic new lows and actually officially reaching that bear market status. But I think, Ola, clearly the big mover, and I've got a chart here, is the oil market. I mean, just a fresh multi-dollar hammering of the oil price yesterday.
You can say that when we have uncertainties or developments of both on the supply side and demand side going in a negative direction at the same time, then oil's really got nowhere to hide than basically go lower. And that's really what we're seeing right now. The supply glut is still an issue. OPEC has announced they want to cut production. U.S. production is hitting new records. Russia is slow in cutting their production. Saudi Arabia needs quite a high oil price next year to balance their books. So it all just leaves the market really uncertain about whether they can cut enough to stabilize the market. And then obviously all this demand growth, the worries we had this week, oil has really also become a bit of a macro play because as stock markets hit lower, oil hits lower as well because it's the demand growth worries that's impacting. And I think also China, obviously China's the world's biggest buyer of oil, and President Xi's comments yesterday didn't really give any new signals about additional stimulus, and that also hurt the market.
Right. So on to the FOMC meeting, and there are an awful lot of moving parts here in how Powell can deliver a more dovish shift. You have this sort of baseline expectation that we're going to see a so-called dovish hike. In other words, we will get a hike delivered. This is what's expected, at least by around, depending on who you're asking, 50 to 75% odds that this hike unfolds. But there are other factors here. I've tried to put it together a few on this not terribly visually interesting slide here, but I think the initial reaction, of course, I think the market is going to be extremely tuned to whether there's a hike or not. And we could see a very fast and very volatile knee-jerk reaction to that. We have Trump, of course, shouting from the rooftops to lay off the hikes, to telling Powell to cease and desist. But no less a legendary figure than Stanley Druckenmiller out in a very long Bloomberg interview. And this came after a Wall Street Journal op-ed together with a former Fed official, Kevin Warsh, sort of asking the Fed to stop as well. And he lays out his reasons for why. He sees this as a liquidity event. He sees the Fed as needing to lay off because financial conditions have gotten parlous. If you look at where we are in the equity markets, and the Fed, even if it's going to continue to hike possibly out into 2019, simply needs to pause because financial conditions could over-tighten here, and we could get some kind of very ugly liquidity event that then has some very unfortunate consequences and forces some kind of overcorrection across markets.
I think the problem as well now is Trump having been so vocal and all this worry about central bank independence. Even though he obviously sees a hold as being positive for the stock market, and that's what he's starting to get worried about. But the market may see that as an interference,
yeah, exactly.
And that's why. So even no matter whether we get a hike or not, the risk to stock markets remains.
And as well, I think Druckenmiller really addressing that very specific issue in that interview, and he talks about the idea that the Fed would go ahead with a hike simply to make a statement rather than to address financial conditions worries would be almost even more political than not hiking for reasons with or without Trump. So that's key, of course, the hike itself. But there's also the idea that the Fed is going to hike, and again, the dovish hike and the dovish bit being in the guidance. And there's talk here in sort of the mainstream type research that, oh yes, they could lower the dot plot to maybe only 2 hikes rather than 3. I think Powell, to make a bigger statement here, could do something like, and I think he would like to do something like entirely getting rid of the dot plot. I don't think Powell likes forward guidance. Druckenmiller also addressing that issue, that forward guidance has some very unfortunate consequences because it handcuffs the Fed into a preset course of action. And then I think the big aspect in the room here is the quantitative tightening, that rate of $50 billion per month, on top of the huge issuance needed to finance Trump's tax reform inspired deficits. This is an issue. Could this the quantitative tightening schedule, which is essentially on autopilot, something that Powell inherited, also be looked at? So we have the moving part of the hike or no hike. So even if we do have a hike, if there's a sufficient dovishness in these other factors, especially I think on the quantitative tightening side, it could be very interesting. We have to be very careful about the initial knee-jerk reaction. Now, and my final point on my slide here was that, okay, what if Powell does manage a dovish surprise? Perhaps not any hike, perhaps some major adjustments to that forward guidance, but it isn't enough. And then we see this dollar liquidity spike or liquidity worries continuing, and a continued risk-off situation. Then I think, very important, last point here on my slide is the scenario that Sten Jacobsen, our chief investment officer, looked at in an article on an op-ed on home.saxo. Please look at that one. I think it's a very compelling and relevant article, that we risk some sort of policy panic. I mean, if we do see the dovishness from the Fed and the market still can't find solace in that, then we have quite a situation on our hands, whether it's in oil markets, commodities, risk appetite in general. All right, dollar yen I think is less straightforward. If we were talking about dollar liquidity being the issue, does a dovish setup, or does a risk-off response really see a tremendous follow-through lower in dollar yen? I would say that if we do see a strong risk-on response to whatever the Fed delivers, then dollar yen will not be one of the currency pairs in focus. Regardless, it's very interesting support levels here around the low 112s, and it could be an interesting setup for a move lower. And in gold, we're seeing a pretty well-bid gold price. We have that stability in the Chinese yuan. How do you think, Ole, the market's reading gold here?
Well, funds, both speculators and investors, they are returning to gold. They have been returning to gold now for the past couple of weeks. Hedge funds are now back into a net long for the first time in 5 months. We've seen the biggest pickup in ETF demand since April. So it does indicate that gold is starting to reassert its role as an alternative investment when we have uncertainty elsewhere. As you look on the chart here, we can see we haven't really broken any significant levels just yet, but the market is right now is just hovering below the 200-day moving average, with 1263 being the next major level. But at least some underlying support is coming in. But obviously that support needs to be maintained, because there is a lot of new longs in the market over the last couple of weeks. So we need to see the reaction this afternoon. But overall, it looks like it's building up for some further gains into 2019.
Okay. And then we have we put an industrial metal chart here with copper suffering a bit as well. I guess this is a whole link to the global growth and of course China interest. Yeah,
copper has actually been relatively calm. We saw the sell-off back in at the beginning of the year when the trade war was kicked off, and since then it's been hovering around this 275 area on the high grade. And we just had a small breakdown yesterday. Again, the President Xi's comments in his speech yesterday did not offer any new clues, but we got the conference or the Central Economic Work Conference later this week, where we may see some news drip out from that, and potentially some additional stimulus. But copper is in need of that for the time being, even though the fundamental outlook into 19 looks pretty supportive, because we're seeing tightening supply, much opposite of what we're seeing in oil at this stage.
Okay, that takes us to our economic calendar for today. Really, the only item that should be on here for market focus is that FOMC meeting. Do recall that this is a meeting, the last meeting of its sort, where we have, well, actually, it's the last, under the new schedule in 2019, of course, there will be a Fed press conference at every meeting, but this will be a meeting with all of the accompanying materials, the Fed dot plot, if that still exists after today, the economic projections and so on. And as I said, a lot of moving parts here. Be very wary of the initial reaction, and let's make sure we've digested everything, both in the statement, in the accompanying materials, and then it's going to be the full reaction to how Powell his stance as he's in this press conference and dealing with, I think, what should be some very good questions given market conditions surrounding this. And I think, again, the scariest reaction would be quite a clear signal from the Fed that it is clearing the dovish bar and then the market not finding confidence. So let's hope the market finds confidence. We do have other factors, quadruple witching into the end of this week. It's the end of the year, maybe some liquidity around that as well. So I think there's just the makings for a very volatile market. I think the equity market will be the highest beta to what's going on here, and FX a little bit less so because we're dealing with those uncertainty issues around Brexit, around what China's plans are for its currency and those ongoing U.S. Trade negotiations. So it feels to me like the equity market is going to be really at the center of the reaction function to this meeting.
So based, no doubt, the most important FOMC meeting since this rate hike cycle began in December 2015.
It feels like it to me, and odd thing being in Forex, at least, the volatility is not being priced very aggressively for the reasons I just mentioned, but certainly for other markets, and it will have longer-term implications once we do get those key FX-related issues cleared up in the new year, probably in the first couple of months with Brexit and
setting the stage for
China.
2019.
Exactly. I think it's going to be a very dynamic year, and we could have a pretty rough ride, rough sledding into, in volatility terms, into the end of this year. So stay very careful out there. Be wary of the potential for volatility here. And we'll be back, of course, tomorrow morning with a look at how this played out and our reaction to what has unfolded over this FOMC meeting and the market's reaction. Thanks for today.